Hey there, everyone. Happy Friday and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. This is a special all mailbag edition of the Final Bar. Again, the mailbag is always open, ready for your questions. What are you running into as you're trying to make sense of these markets in a Fed week with markets testing new all-time highs, with all the volatility and all the uncertainty we've been dealing with? We are here to help you address those questions. Email is the best, thefinalbar@stockcharts.com. And let's get to question number one. Dave, which would you say is better as a short-term leading indicator for a stock, RSI or accumulation distribution? Interesting question, and to be honest with you, these are actually two, while I think they probably feel like very similar indicators, are actually a little bit different. And I'll show you an example here. We'll take IBM. RSI, we're probably familiar with because I use it on the show pretty much every time, and this is one of the most common indicators that I use. It's my favorite measure of price momentum. And if you think about it, the reason why I use an indicator like RSI is because price itself is pretty noisy, right? We're sort of in trends, we're sideways, we're doing all these things. But RSI is kind of like taking, and if you know your statistics, kind of like taking a Z-score of the price action. And what a Z-score does in statistic is basically normalizes things. So if you look, sort of the contours, right, the up and down swings of the price are pretty similar to the up and down swings of the RSI, but it's standardized, right? So it ranges from 0 to 100. 50 means it's kind of neutral. Above 70, it's overbought. Below 30, it's oversold. And it's a great way to compare that sort of consistent, statistical measure of momentum versus price itself, which has direction and trend and momentum all kind of wrapped into one. Now, in the bottom, I'm going to add the indicator you're asking about, which is called the accumulation distribution line. Now, the accumulation distribution line is actually very different. This is actually an indicator created by Mark Chaikin. And I would tell you he further evolved, I think, what accumulation distribution did through things like Chaikin money flow, which is where I would encourage you to get if you want to look at volume. And that's the big difference, right? RSI is basically the relative strength index designed by Wells Wilder in the 1970s. It literally looks at the average up day and the average down day over a period of time. So when the stock closes up, how much higher does it tend to go? When it closes down, how much lower does it tend to go? This is a ratio of the average up day versus the average down day, and it's smoothed out using some exponential smoothing factors. So if the RSI is at 50, what it's basically telling you is that the up and down days are pretty even. If the RSI is above 70, that means the up days are much stronger than the down days, and if the RSI is below 30, the down days are much stronger than the up days. So it's literally telling you about the relative movements on up and down days just based on closing prices. Accumulation distribution is actually using volume, and instead of looking at a daily volume reading, you're using, basically looks at where we're at over a period of time versus the high and the low, and weights that daily volume reading based on where we close within the range. So it's really a volume-based indicator. So RSI, I would bucket with other momentum, price momentum indicators like Williams %R, the commodity channel index, the true strength index. Those are all kind of price oscillators. Volume indicators, besides just volume, would be on balance volume, accumulation distribution, Chaikin money flow. Those are all plays on how to weight volume in a more effective way. So I actually would say the two of them are more complementary than you think. The danger of looking at two indicators that are very, very similar is you're not really adding any value, right? Why not just pick one and stick with that? Using different types of indicators in meaningful ways and looking at how their signals are related to one another, there I think you're really getting to something. So I would argue using RSI or a measure of price momentum, using accumulation distribution or one of those other measures of volume, I would say actually is a good way to combine the best of both worlds. Use that along with your analysis of price. I think you're probably in pretty good shape. Thanks for asking about those particular indicators. Next question, how do you use SharpCharts versus ACP on StockCharts? And you pointed out, and you're absolutely right, I tend to use SharpCharts, which is our main charting engine or our original charting engine on the show. This is what I was just showing you on IBM, but I do use ACP. Right now, to be honest with you, we have two different charting platforms. We have our regular SharpCharts, which you're probably familiar with. That's this chart of IBM. And then we have what's called ACP, our advanced charting platform. These are actually two separate charting engines. What I will tell you is right up front, over time, I think you will find that the two of these become a lot less different and a lot more similar because there are things about the advanced charting platform they actually can't do with the current version of SharpCharts. Our developers are actually redesigning this charting engine from scratch It is taking about as long as you think it would to redesign a charting engine from scratch. So it's not done yet. But when it's done, we should have a lot more flexibility. And so what happened, a couple years ago was it was just way easier to add new and exciting things in ACP because we had a new language and a new, basically a new starting point. And SharpCharts is based on original code that our founder, Chip Anderson, wrote a couple years ago. We'll call it like 25 plus years ago. It's still sort of based off of that original code. So redesigning that should make things better. So why would I use one or the other? Here's what I will tell you. For what I do as a market strategist, publishing charts, writing reports, doing YouTube videos where I'm sharing, an example and I want to walk through it, SharpCharts are fantastic because what it's basically doing is creating a series of images. So when you create a chart and you add your lines on it, it literally is creating like a JPEG image. And if you right-click on the chart and say download chart image, it's going to look pretty much exactly how it looks on the screen. And I will tell you, I've used other charting platforms where it looks really good on your screen, then you try to export it and it looks absolutely horrible. You will not have that issue with SharpCharts because it's already basically an image that you are working with. And that was a thoughtful decision that Chip made years ago, which I'm thankfully did, because putting this in a PowerPoint, it looks about as perfect, and you can change the pixel count and make it look exactly how you want. ACP is more of a dynamic charting engine, so you can do things like click and drag the scales, you can stretch things out and stretch things up, you can move indicators from one panel to the next and make it look as crazy as you want to. I wouldn't do that, by the way, putting RSI with price. It makes no sense, but the fact that you can do it tells you that there's some opportunities, and depending on what indicators you can do, you're looking at, it allows for some really fantastic capabilities and some really things to stretch your, interesting ways to stretch your thinking. Looking at RSI with multiple settings and stacking them against one another and doing all sorts of annotations. So I would say ACP is great for the flexibility. It's also great for looking at multiple charts at the same time. So here I'm looking at a candle chart and a bunch of relative performance lines and a weekly chart all at once. And that's something that we can do only in ACP at this point. So that's how I would think of it, right? There are different ways to experience and to analyze the data using our different charting styles. For good examples of people that use our SharpCharts platform very well, I would look at my own show. People like Tom Boley, Mary Ellen McGonigal do a great job of using SharpCharts and showing all the conclusions you can draw by using that charting engine. For ACP, look at people like Grayson Rose, Joe Rabel. They do a really good job of using the advanced charting platform and showing a lot of the capabilities and things you can do. And again, overall, over time, I think you will find less and less differences between those two because we're trying to take the best of both and make both of our charts a little more elevated. So that's how I would use the two of them now. Next question, can you discuss the difference between Keltner bands and Bollinger bands? Keltner bands, I actually would usually call Keltner channels, but to be honest with you, same thing, and I knew what you meant. We have a great article that actually addresses this, and so I'll point you to that. And by the way, if you ever have a question like this and you want to kind of do some digging, all you need to do is in the upper right corner of the screen, or if you're looking at a page like this, just go to the little lines and you'll find this little search button. What you want to do is go there and type something like Keltner or Bollinger or moving averages, whatever you want to learn about. That'll show you some of the chart school articles like this. We have an amazing database, amazing group of resources called our Chart School. It is free for everyone. When I was learning technical analysis 20-some years ago, I was using StockCharts.com and going through Chart School, and it was one of the ways that I was able to enhance and better understand some of these different technical indicators. This article in particular tells you what Keltner channels are. Keltner channels and Bollinger Bands are actually very, very similar. And further down in this particular article, there's this really good chart I wanted to show you that shows the two of them together. And as you can see, they're both based on trading bands. So they're both very similar. The difference is how those trading bands are created. So Bollinger Bands start with a simple moving average, usually a 21-day moving average or a 20-day moving average. And then you do two standard deviations above and below. So it's using standard deviations over a look-back period as a way of determining the width of the band. So the more volatile the stock, the wider the bands are. Keltner channels doing kind of a similar thing, but it's based on average true range. You have an exponential moving average in the middle, and then you have you use an average true range calculation to determine those bands. And you can see the formula in these articles. They're actually really, really good. So here it's actually a 20-day EMA plus 2 times the 10-day average true range. So what's the daily trading range for the last 2 weeks? Multiply that by 2, and there's your upper channel, and the opposite for the lower channel. So I would argue how are they different or similar? They're very, very similar. I would say, maybe the difference is Bollinger Bands tend to expand based on volatility because they're based on average, or they based on standard deviation. So if the price moves, both of the bands are going to blow out. Keltner channels are going to follow the price a little closer because it is taking average range subtracted from a moving average. So it's the same amount. So the width is going to be the same, and it's going to kind of come out an amount. So you see the blue lines with the Keltner channels kind of track the price a little closer. The Bollinger Bands will widen out if the volatility is expanding. I think in practice, to be honest, I think they both have their merits. I just saw John Bollinger about a month ago in Dubai and really enjoyed his presentation. He addressed Keltner channels and how he thought of Bollinger Bands and what he likes about them. Again, I think both of them do a really good job of showing you when a price move is extreme, right? What's sort of that outlier move where we're way out of the norm, and anytime the price is outside of those bands, whichever one you use, that's the signal you want to look for. For more info on those particular indicators, how to use them, and the comparisons between the two, go to the articles in our chart school page. Again, just hit the magnifying glass and search for Keltner channels or Bollinger Bands. You'll get to great articles like this that show you some really helpful examples to help you make sense of those two indicators. Next question. How can I use StockCharts to scan for stocks where the scooter ranking, the StockCharts technical ranking, just recently broke above 75? Really good question. This is something that Grayson Rose mentioned in our recent episode. I think it was our top 10 charts for March 2024, which is a monthly exercise Grayson and I do over there in our interview set, and it's a lot of fun. It's a blast. I'm already looking forward to the April one, which will be coming up here very, very soon. We sit down once a month and just talk about 10 charts that stand out to us, things we're going to be watching for the month and talk about. And I remember Grayson mentioning something that Greg Schnell often looked for, where was a stock with a scooter ranking that's improving, and he always said breaking above 75 is a good measure. I'll start out by telling you this. Looking at that same chart of IBM, we actually have an indicator called Scooter Line, StockCharts Technical Ranking Line. And this is really showing you the trend in the scooter ranking over time. And this is something that Greg in his work often would show as an indicator. I rarely do that, but he has found it helpful to look for stocks that have been lower in the scooter rankings and then breaking out. Because what it means when it breaks above 75 is all of a sudden it's in the top quartile, it's in the top 25% of that universe, right? So if you think of IBM as part of the large cap universe, so you take all of those large cap stocks and you rank them from 1 to however many hundreds, and you put them in a percentile ranking. So if it's at 75%, that means it's the 75th percentile, or the top 25% of the top quartile of all of those stocks in that universe. So to directly answer your question, yeah, you definitely can do it. Go to the scan engine. Easy way I like to get that is from your dashboard. You can click on scans. I actually have one that I created particularly looking at this, and I set it up earlier today when I saw the question that you sent in. This is what it is. I'll edit the scan just so you can see it. It's this line right here. There are a couple ways you could do it, but the way that I like to do it is this line right here, line number 5, which is basically the scooter ranking, the X75, and all that X means is it crossed up, right? So SCTR crossed above 75 means any scooter ranking, depending on what universe. So here I'm looking at the S&P 500 stocks. I only want stocks where the scooter ranking just broke above 75. You can also, by the way, I had this other argument which I've grayed out, but you could also specify a particular market cap range. So SCTR.large or .mid or .small will focus on that particular scooter universe. You can also just use filters like index membership and market cap range to sort of curve fit that a little bit or filter that universe a little bit further. But when you run that scan, you will find stocks where the scooter ranking is just breaking above 75. So here I'm running the scan right now, like AIG is popping up. We'll do that. And I have a chart style called Scooter, which shows it to you. So here we go, right? We're just breaking above 75 today, and that's why it comes up on the scan. So that's the way you can do it. It's a great, again, the indicator, looking at the scooter rankings over time, can show you when something has really been underperforming its peers, but is really starting to improve. And a scan like this is going to help you find these kind of names that have really not been performing well on a relative basis, but all of a sudden are really starting to show renewed signs of strength. And that's why Greg looks at it. That's why I think it might be a good scan to run. Great question, by the way. Next one, Dave, what is your approach to multiple time frame analysis? It's a really thoughtful question. That could be a whole hour-long webinar, to be honest with you. Maybe someday I will do that. But I did bring up this page in ACP. Again, what I like about ACP, to answering the question earlier, is it allows you to look at multiple charts together. If you watch like Joe Rabel's show, he will often start here and then zoom in and out on some of these different time periods. So there's my weekly chart. Here's my monthly chart. I can zoom in, make some annotations, kind of zoom out. And I'm a huge fan of that sort of analysis. I rarely show this on the final bar, only for simplicity. I try to just stick with one chart and one time frame because we don't have the time to go through a thorough analysis of any of these names. And don't assume when I'm showing you a chart of Apple, a daily chart, and like that's it. If I was really analyzing Apple for an institutional money manager, I would do a multiple time frame analysis. I think about some different approaches and really try to paint a complete mosaic. We just don't have time on the final bar to really go through that sort of rigorous analysis, but that's where you want to kind of get to in your own work if you can. What I like about this, and this chart really represents how I think about multiple time frames. For me, I think you want to start with kind of your go-to time frame. So for me, I'm usually looking about 1 to 3 months out on average, and that's kind of a generalization, but that's usually the time frame I'm trying to trade for, I'm trying to invest on, right? And I'm trying to just get a sense of where I think things are headed for the next 1 to 3 months. Now, I also have longer term accounts like retirement accounts where I'm thinking more about monthly trends and longer term trends. I have a tactical account where I'm looking more at short term swings where I might use a candle chart, but this is kind of my go-to chart. The 1 year, the 2 year daily chart is really what I look at. So I start here, but then I also have some of these other time frames. So I start there, but then I would also say, all right, if this is what the daily chart of Apple looks like, how does that fit into the last 5 to 7 years? And that's where the weekly chart can be helpful. So now I can see that daily time frame is really just looking at this period. And I have to remember that Apple is coming out of a multi-year rally going into that chart that I was looking at there. The monthly story of Apple has obviously been a story of incredible gains. And when I'm looking back at the last 15, 20 years, you can see this incredible generation of wealth that Apple has been able to create over multiple decades. Now, when I'm actually timing a trade on the daily chart and really thinking about it, then maybe I want to look at the candle chart and think, all right, just in the last couple days, am I seeing any candle patterns that tell me about a particular change? Am I seeing a hammer candle or a bullish engulfing pattern or something that would tell me, okay, maybe I really like Apple here, but today's not the day because I'm seeing this short-term reversal. Maybe I want to wait a day or two and look for that. So if you really want to do multiple time frames well, I would be using ACP and I would be stacking some of these different charts together. Keep it simple. Start with like 3 charts, right? Daily, weekly, monthly. If you're more shorter term, maybe add an hourly or a 5-minute chart and have a couple of them together. And you'll find over time which charts are you using more, which charts are you using less. For me, this is a great way to think about candlesticks really representing the really short term, that tactical time frame, how that relates to the time frame I'm operating on, and then how that relates to the longer term trends. And understanding those relationships, I think, is a big part of the game. So great question there, by the way. That was the 2-minute version of an hour-long webinar. Maybe I'll work up at some point, but not today. Next question. How much weight do you place on an idea based on the underlying sector performance or trend? And that's a really interesting question, actually. It made me think a little bit, because you're saying if the XLY is performing well, would you own Tesla because the XLY is performing well? So the short answer is no on that one. But what's the longer term answer? So I would say there are 2 different ways to do this. And by this, I mean picking stocks, right? If your goal is to have stocks in a portfolio for whatever reason, you have 2 general ways you can think about it. You can go top down or you can go bottom up. Top down is basically I'm starting with the big picture. I'm starting with the macro perspective. Overall, and I'm making these conclusions up, don't think this is a recommendation, but let's say overall, I think the market is strong. I think the trend is positive. I think overall the S&P and the NASDAQ are probably going to go higher for the next couple months. That's my macro perspective for whatever reason. Then I would think about, all right, if that is true, then what sectors are going to do well in that environment? Well, consumer discretionary is probably one of those sectors that would do pretty well. Similarly, analyze the chart of XLY, and I could say, all right, it's actually making higher highs and higher lows. Recently pulled back to a 50-day moving average, and the price momentum is pretty good. It's not been performing relatively well, but overall, I like the setup here. So, okay, XLY is a good place. Now let me look at some individual stocks within the consumer discretionary sector, and that's where I might use the scan engine to find names within the XLY with a strong scooter ranking or that have been up over a certain look back period, or have had a buy signal from PPO recently, or something that would help me identify actionable stocks within that sector. The other option is to just start from the bottom up, right? Run a scan looking for stocks making new 3-month highs, which is a scan that I often run. I don't care about what sector it is or whatever. I'm just looking for stocks that are actually working. So one of the scans that I run all the time, here it is at the top, new swing highs, 13-week. This is my standard stocks above 5 billion market cap making a new swing high. And I sort it by sector and then industry. And I start at the top and I look at Disney and then Live Nation I go through. And I'm thinking less about what sectors are represented. I'm looking more at those particular stocks. And GoDaddy is a strong chart in that it's making higher highs and higher lows. So I might want to own GoDaddy regardless of what sector or group it's in. I just think it's a good chart, right? So the bottom-up process is just I'm looking for good setups in wherever they are. And if it's a utility stock or an energy name or GoDaddy and communication services, I don't care. I just care about owning strong charts and wanting to be in those. To be honest with you, I think a lot of people do a little bit of both, and that's kind of where I am at. I have a portion of my own portfolios that are more model-based, that are really just looking at a macro perspective. Overall, do I want to be risk on or not? And which places, what ETFs I think provide that upside potential or downside protection, given what that analysis is. And then I also am looking opportunistically for stocks making new swing highs and lows. And that's really the type of analysis that Grayson Rose and I do on our monthly exercise. We're talking about top charts for a particular month. So, so owning Tesla just because it's in a particular sector, not something I would encourage you to do. I would focus on actionable names, good stocks within sectors that you like, and think about what charts represent those characteristics that you would look for. Another way to think about this, by the way, just to finish up, is there's a chart style that Gaddis Rose shared with me a while ago, and it's this one, and it's kind of busy, but it's really cool. So here at the top, we're looking at Tesla. This is Tesla relative to the overall market. Here's Tesla's sector, consumer discretionary, versus the overall market. Here's Tesla's group versus the sector, and here's Tesla versus the group. So these 4 lines tell me, how is this stock doing relative to the overall market? How is the stock's sector versus the overall market? How is the stock's group versus its sector? How is the stock versus its group? All 4 of these lines are going down. And I would tell you, if you're looking at that sort of pattern, this is telling you the stock is underperforming the market. Its sector is not doing particularly well. The group is not doing well within the sector. So it's not even one of the better groups within consumer discretionary, and the stock is underperforming its group. So you want stocks where these lines are turning higher, and that's how I would think about an individual stock within a group and within a sector. Hopefully that helps you make sense of that question. Thanks for asking that. Next question, would you use adjusted or unadjusted data to identify resistance levels on weekly charts? And you were looking at a particular stock called Brinks Company, ticker BCO. This is an industrial stock. Thanks so much for sending your chart that you're looking at. This is in ACP. You have a daily chart here. I'm seeing RSI in the top, PPO in the bottom. You have some annotations that you put here sort of indicating different levels, and that's great. I think you were talking about this particular level here. You're saying, all right, it broke out, it had a what's called a throwback. I call this a pullback. I think the technical analysis books probably call this like a fallback or a throwback or something. I'm not a fan of that. I call it a pullback, but whatever. Anyways, it came down a little bit, and then it bounced back higher, and then has now in an uptrend. And you're looking back toward a previous resistance level, and you're saying, when I'm doing a weekly chart, so let's do that, and then I'm guessing you're probably doing a little more data, like maybe looking back at this high, and you're saying, on the weekly chart, it looks like 92.18, which we're just below here. But if I do unadjusted data, that level's probably different. Yeah, so unadjusted, the level's 97.12. So what gives there? So we've talked about this before, but just as a quick refresher, our default data sets, when you type a ticker like Tesla or Apple or BCO, you are looking at an adjusted data set. And what that means is a company like Brinks pays a quarterly dividend, most likely. I can see that it does. It's not a big one. It's 1% dividend yield right now, but it's a dividend that it pays out every quarter. What happens when a company pays a dividend is it pays out a portion of the stock price out to shareholders as a quarterly dividend. So the price of the stock actually comes down by the amount that the company is paying out in the form of a dividend. So you're trading capital appreciation for an income payment, for a dividend payment. So the raw data set actually has these little gaps every quarter because of the dividend payment. We made a decision in StockCharts years and years ago based on John Murphy's guidance that adjusted data was better, particularly for technical indicators, because by putting those little dividend payments in, you're basically saying that a gap in the price is something you want to analyze using something like RSI. And his opinion was indicators should be based just on price movements based on buy and sell decisions, not based on a capital change or a structural change in the stock. So when you type a ticker, it's using an adjusted data set, which means when a company pays a dividend, all the historical data is adjusted down a little bit to adjust the new data. That's why this high from first quarter of 2020 is reading as 92.18. But if you do underscore BCO, which is the unadjusted data, you can see in real life in January of 2020, the stock was actually trading at 97.12. And that difference from 97 to 92 is the cumulative effect of all those dividends and that we've adjusted the data down. Day to day, if you're looking at a chart on an average day, you're not going to tell much of a difference. It really only makes a difference when you're looking at long-term comparisons. And if you are interested in what a previous market peak or valley was years ago, you definitely want to use the unadjusted data set because that's where this stock was trading at that particular time. We do adjust for splits, which there's no one on this planet that does not want to adjust for splits, in my opinion, or if not, they should. So that does include splits if those would happen and reverse splits. But in terms of the actual resistance, that's what I would use. In general, I use the adjusted data. I don't worry too much about this unless I'm looking at a higher yielding item, something like a bank or a utility or a REIT, which has a higher dividend, then the adjustments really can make a dramatic change. Last question, do you think that earnings beats or earnings misses can cause a, quote, change of character in the charts? And I'm summarizing your question. You basically said, hey, Dave, listen, you don't talk about earnings too much on your show, so what's up? Don't you care about earnings? And I'm putting a cynical tone on your question, which maybe was not there, but that was basically what you asked me. Why are you not talking about earnings? There are two different ways to think about earnings, to be honest with you, and I don't know if there's a necessarily a right way, but there are basically different ways to do it. I'm poking around on charts here, but basically there are two ways you can think about a company and what happens when it reports earnings. Number one, you can pay a lot of focused attention to the earnings release, and when I've had Danielle Shea on my show, she often, because she has a whole discipline talking about trading around earnings dates and looking at what a stock tends to do around earnings and what you may want to anticipate and whether something is unusual relative to the normal trend in earnings. And on our SharpCharts platform and on ACP, we actually allow you to overlay earnings. So on SharpCharts, it's in a section called Overlays, and it's in kind of a similar place. You want to select this guy called Events, and then you'll see these little things that represent a dividend or like earnings will pop up as those little drops, and that'll tell you when a company has actually reported something. And as a result, you can see the relationship from one quarter to the next. To be honest with you, price gaps are usually the best way to see that a company is reporting earnings, just because the price will gap from one day to the next. Usually happens about once every 3 months. You can see here's a gap at the end of February, most likely due to an earnings release from United Health Group. So you could think about the particular earnings date. What I would argue is that earnings expectations and the reaction to earnings, for me, it's all about looking at the price action and how it results to that. So I definitely want to know when a company is reporting earnings, and that's why we added that to our quote line here. So we see that the company last reported earnings, I was wrong, it was actually here, January 12th. This gap right here was an earnings announcement. The next earnings is going to be mid-April, so we've got about a month to come before the next earnings release. That's why it's actually really helpful to have right at the top there. So knowing that an earnings date is coming up is really helpful. That's why we also have an earnings calendar. So if you go to the main charts and tools page up here, on the right side, you'll see an earnings calendar. That can be helpful to just understand which companies are reporting earnings coming up and make sure you're prepared for names in a watch list or in a particular index that you may want to be aware of. But in terms of analyzing the price related to earnings, I would argue that the chart is probably the best way to do that. So thinking about what happens when the company reports earnings, looking at the price gaps and how the stock has moved when the company is reporting earnings before. But for me, it's all about analyzing the price trends. And arguably things like earnings and news adjustments and financial filings and insider trading, all of that arguably should be reflected in price itself. So if you know nothing else about a stock, look at the price action. That's the most important stuff you need to know. That's how I would answer that question, maybe in a somewhat long-winded way. But that's it for today's special edition of The Final Bar. Thanks so much for joining us every weekday after the close for The Final Bar. As always, please keep your questions coming. TheFinalBar@StockCharts.com. is the best way to get your questions our way. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.